Hello everyone, good morning. We'll wait for 1 more minute so that everyone can join. Okay, so I hope yesterday's session was good and everyone did understood each and everything. Today we will be starting, like 2 credits were left. We'll quickly complete only 1 credit, I mean education. In that we have AOTC and LLC. We'll take just 5 minutes to complete this credit, and then we will be starting with our most important topic, that is IRA. Okay, IRA is the most important and examiner's favorite topic. So many questions will be asked from that. So yeah, so let's start. For education credit, we will be having 2 types of credit for education. One is AOTC and the other is LLC. Okay, AOTC is American Opportunity Credit, where you can get a credit for any qualified expense which you are doing for your education, for a higher education. Qualified expense for AOTC, and for LLC is lifetime learning credit, is little bit different. LLC is totally non-refundable, but in AOTC you can get a certain part, a partial part is refundable. We will see that what is the limit and everything. Maximum AOTC credit which a person can get is $2,500. Okay, and this 2,500 is calculated. How it is calculated? 100% of first 2,000 and 25% of the next 2,000. So if you are spending more than the $4,000, you will get a reduced credit. Okay, 100% of the first 2,000 and 25% of the next 2,000. It is allowed as a per student basis, not on as per the taxpayer. Per student basis it will be allowed, and it is allowed only for the, if you're expensing for the graduate degree, like undergraduate degree, like BCom, MCom, we call it in India. Okay, so undergraduate degree AOTC will be allowed, right? Recognized education credential should be there. Credit allowed for the expense incurred. Okay, now what all expenses will be there, we'll see later on. First thing you have to remember, this is the main point which is segregating AOTC and LLC. Here it is allowed during 4 years only. Your 4 years education course, higher education which you are taking, it is allowed for the 4 years only. LLC is for lifetime. That's why the name suggests is LLC, lifetime learning credit. Means even after completion of the 4 years, if you want to take the higher education, right, you can go for LLC credit. And if you're not eligible for AOTC, you can easily go for LLC credit. Eligible person are the taxpayer, spouse, dependent who are not convicted by any felony. Okay, who like over there it might happen that some people are convicted due to some felony and they are in the detention center. So those people will not be eligible for AOTC. But can I say they are allowed in the LLC? Yes. As I mentioned, those who are not there, those who are not going to take the AOTC, they can easily take LLC credit. What is the phase out range over here? Yesterday I mentioned the a way to calculate the phase out limits, that was from the lower limit to upper limit. Whatever is your AGI, if your MAGI is falling below this limit, full amount will be allowed as a credit. As soon as your AGI exceeds 80,000 in case of education, for AOTC, LLC, both, for both the phase out limit will be same. Okay, so if it exceeds this amount, that much portion you have to proportionately reduce from your credit. Okay, so for MFJ it is 160,000 to 180,000. Students should attend the college for at least half of the year. See, as this is refundable credit, this comes with a lot of restrictions. Means you will have to attend the college at least for the half of the year. See, it is allowed only for 4 years. AOTC is allowed for 4 years. You will have to attend the college for at least half years. Due diligence requirement is there in the AOTC. In each and every refundable credit, you will have to fill out the form 8867. Refundable amount of this credit, as I mentioned, AOTC is not totally refundable, but partially you will get the refund. Okay, what is the credit eligibility amount? 100% of first 2,000, 25% of next 2,000. Once you know whatever is your eligible credit, let's say $3,000 you are going to get a not $3,000, it will be less than 2,500. So let's say you are going to get only $2,000 as the eligible amount. Out of this, you are going to get a refund of 40% of eligible education credit. Right, and this will be limited to maximum $1,000. See, I don't expect you to remember all the limits in part 1, but in regular class also I've mentioned, for credits chapter, please remember each and every limits, each and every this refundable portion, because in exam they'll not give you this percentage and this amounts. These are fixed percentage and these are fixed amount. This don't keep on changing each year. That's why I'm saying please remember all the limits in the credits chapter. Okay. All right. No credit will be allowed if you are a MFS or if the taxpayer has claimed as a dependent on someone else's return. Okay, if I am been claimed in someone else's return, I am incurring my own education expense, I won't get any credit. But the person who is claiming me dependent, right, and if he is expensing for me, the main word here is a qualified expense. The expense should be incurred by the person taking the credit. And if you're filing a MFS return, yesterday we saw a whole list, right, that if you're going to file a MFS, you're not going to get a few benefits. So make sure you remember that whole list very well, and in exam they can twist this thing. Okay, is that you are filing a MFS and they'll give you a lot of scenarios in the question, then you have to apply your mind that first word it is saying they are filing MFS, then this credit is not allowed at all. Okay, what are the qualified expense for the AOTC? For AOTC, the qualified expense will be books, supply, equipments needed for the course, whether or not the taxpayer purchased from the institution. See, this wording is important, that sometimes it happens that the books and the equipments and every required things for the course is to be purchased from education institution only. But in AOTC, whether you purchase from institution, whether you purchase from outside, but that has to be relevant to your education course, okay, then it is allowed. It should not be anything which is irrelevant to the course. For example, it's a IT college. Okay, now in IT college, what will happen, they'll provide a laptop at the time of admission. So that is the equipment which is provided by the educational institution, that will be allowed, that fees will be charged in the admission fees, in the enrollment fees. So that amount is allowed. If it is provided by the educational institution, that thing is allowed in LLC. So in LLC, if you get equipment, see, books, supplies, equipments, only if purchased from the institution as a part of enrollment or attendance. Okay, in AOTC this restriction is not there, but in LLC you have these restrictions that equipment, everything. Guys, just mention yes or no in the chat box. LLC, they will be the thing that books, supplies, equipment, everything should be purchased from the institution only. Then only you will be allowed that credit. Let's say you are joining the IT college, but you are not purchasing the equipment from the institution. You are purchasing separately. That thing will not be allowed in LLC. LLC is non-refundable. Again, I'm saying just go through this chart, the differentiation again. Maximum LLC credit which you are going to get is $2,000. What was the AOTC maximum credit? 2,500, right? And this was 100% of first 2,000 and 25% of next 2,000. Over here, LLC credit will be flat 2,000 and it will be 20% of your first $10,000. So if you are expending just $5,000, so take 5,000 into 20%. That will be your LLC credit. Okay, and this credit will be allowed for same for per student basis. Credit allowed will be for tuition fees, books only if along with the tuition. Means if they are providing, the education institution is providing you the material, they are providing you the books and everything, then only it will be allowed as a credit. Okay, else it will not be allowed. It will not be allowed as a qualified expense. Okay, right now first step you are going to do is calculate the qualified expense. Compare it with the maximum credit which will be allowed. It falls between amount when credit which you calculated earlier, the 2,000 or 2,500, will get proportionately reduced. Okay, how to calculate the proportionate amount we have already done in the previous session. Okay, just take the lower limit, upper limit, take the Maggie. Let's say my Maggie is falling somewhere between 80 to 90,000. So what you will do is, whatever is my Maggie minus lower limit, divide by upper limit minus lower limit. This much amount I am going to reduce either from my 2,500 or 2,000, whatever is the eligible credit, I am going to reduce my credit by that proportionate amount. Okay, got it, guys? So phase out, we are clear. There is no criteria for attending the college in case of LLC. There is no due diligence checklist which will be required in LLC. In AOTC, it will be required. Okay, this credit is non-refundable, and you can remember like this: wherever 8867 criteria is required, those all credits are refundable credits. There only this criteria is required. Okay, no credit for Maggie if the phase out, no credit if your Maggie is more than the phase out. What is the phase out? 90,000 to, in case of single. In case of MFJ, it will be 1,50,000. If you are MFS, then what will happen? You can't take the education credit, right? Next is credit allowed for the taxpayer claimed as a dependent. Okay, for LLC it is allowed. For AOTC, as I mentioned, if you're filing the MFS, you will not be allowed to take the credit. But if you are taking LLC, see, if you're filing MFS, you are not allowed to take AOTC. Now, can you shift to LLC? Yes, right? Credit will be allowed even if the taxpayer claimed as a dependent on someone else's return or if filing the MFS. Okay. Qualified expense will include all the same things which are there over here. Just remember one thing: qualified expense will not include room and boarding cost. Okay, let's say you are living in the same hostel, or in the same college. Wherever you are there, the room and boarding cost you are incurring will not be included. Guys, just give me a minute. I think my audio is not audible properly. So let's continue further. Education credit is clear, everyone. AOTC, LLC, it's very simple credit, and I think there won't be any like typical question from here. Straight away questions will be there. You just have to remember the limits, the criterias, what are the qualified expense, what is the phase out in case of education credit. Okay, so let's move on to the other topics from our today's day. That was all related to our retirement contribution, distribution, retirement related credit and social security benefit. Okay, I know from previous day two topics are left, that is innocent spouse relief and injured spouse relief. We'll take it later on. Let's start with the IRA. It's a little bit huge topic, so that's why let's start with the IRA topic right now. Okay, I hope everyone has received the book and you are reading it from the book. Those who are not having the book, please connect with me if you want to get this copy. Okay, IRA is over here. Yeah. Okay. So for IRA, remember one thing, we have already done this in the class, but I'll just let you know that for IRA, we will have three things. You will have to remember actually three things. One is, what is the contribution which you can make in case of retirement account? Okay, so IRS has provided some restrictions that only this much amount you can contribute in your retirement account. Okay, so contribution limit is there. Once you contribute, now based on that, IRS gives you one more benefit. You can take a credit that is called as saver's credit. Okay, so once you contribute in the retirement account, you can take a credit based on your contribution. And once you take a distribution, here you'll have to remember there are three things to consider. One is, when you take a distribution, whether it will be taxable or non-taxable, means how much you can distribute and from which account you are getting the distribution. It will depend on that, whether it is taxable or non-taxable, right? Second thing you have to understand is, when you take a distribution, here sometimes you are going to make a charitable donation directly, means you're not taking the money with you. You will just take guide the financial institution that distribute this much amount to this charitable institution. So that is a charitable distribution which you are going to take from your IRA. Okay, and the third thing is prohibited transactions, or I can say what all transactions are not allowed to incur from your IRA account. Okay, so that thing you'll have to remember. A lot of questions will be there from the prohibited transactions, and a lot of questions will be based on this taxability and non-taxability of the distribution. And in distribution, we have one more thing, that is required minimum distribution. Based on your age, you will have to take a required minimum distribution. Means this much distribution, you know, IRS will tell you that this much you have to withdraw. If you don't withdraw, you will be charged with the penalty. Okay, got it, guys? So let's understand very quickly. Retirement account will be of two types. One will be your traditional IRA, one will be your Roth IRA. These are the two general accounts I can say. Apart from this, there are so many accounts that we will learn in the part 2 when we do the part 2 revision. There, the whole different chapter is there. In retirement account, we have different types of plans. Okay, different limits are there, distribution limits are there, contribution limits are there. So let's not get over there right now. We'll stick to the part 1 topic, that is retirement account will be of traditional IRA and Roth IRA. I'll just tell one basic thing is traditional IRA is not that much beneficial. Roth IRA is beneficial. When you contribute to traditional IRA, you will get deduction. But when you distribute, means when you're taking the money out from your traditional IRA, it will become taxable. On the other hand, Roth IRA, when you contribute, it won't be allowed as a deduction. And when you take a distribution, it won't be taxable. Got it? It's a vice versa case. You make the contribution, you take the deduction. You take the distribution, you'll have to make it taxable. Same way for the Roth IRA. When you make the contribution, no deduction will be allowed. When you take a distribution, no tax will be levied. Okay, so that is why on here you'll have to understand that the phase out limit are important. Here the phase out limits are important. In exam, it might possible they will give you phase out in bracket in the question, but sometimes it might happen that if your paper is very hard or it's very worse, then they'll not give you the phase out in the bracket. So you'll have to remember this phase out also. Okay, for traditional IRA while contributing, or for a Roth IRA while contributing, the maximum contribution allowed is $6,000 only you can contribute, not more than that. Okay, and this 6,000 is the sum of all the types of IRA account, means traditional plus Roth will be summed up, and this is limited to $6,000 only, not more than that. But if your age is more than 50 or equal to, more than or equal to, here the word is used more than or equal to, exactly, let's say I'm of 50 years of age, I can make a catch-up contribution of extra $1,000, means I can contribute up to $7,000, right, in any traditional or Roth IRA. Right, so it will be sum of both the IRA account. But let's say if you have contributed more than this, what will happen? Then you have last chance to withdraw your excess contribution before filing the tax return. Okay, so if excess contribution before filing the tax return, means what is the due date of filing the tax return for the 1040? It's, guys, 15th April, right? Everyone knows that. And the extended due date is 15th October. So you have the option to withdraw the extra contribution before 15th April or before 15th October. Wherever you are going to file the return, before filing your tax return, make sure to withdraw your excess contribution. What is the excess contribution? Anything which is contributed more than 6,000 or 7,000. Okay, now when you are withdrawing the contribution, you have to make sure that you don't withdraw the extra amount. See, I have extra contributed to $1,500, and when I'm withdrawing $2,000. So extra 500 which I'm withdrawing in excess will be added to my income. Okay, so if excess amount is not withdrawn, what if you're not withdrawing the amount before 15th or 15th April or 15th October? What will happen? Excise tax will be leviable, that is 6%. See here, two types of penalty you will see in IRA account. You guys have seen already that if you don't withdraw the excess contribution, 6% excise tax is leviable, and the form used is 5329. Don't have to remember the form, it's just for your reference. 6% excise tax will be leviable. Okay, and the second penalty you will see is 10% if you withdraw the certain amount. See here, as I mentioned, there is distribution. Okay, so if you take a distribution, right, and there is an age limit, if you withdraw it before that age, then you will be liable for a penalty. But there are some exceptions, that if this amount is withdrawn for particular purpose, then you will not be liable for any penalty. Okay, that we'll see later on. First, let's understand this phase out limit and everything. First is consequences of contribution in excess of above limit. If you do not withdraw it, you'll have to pay a 6% excise tax on whatever extra contribution you have made. Okay, let's say you withdraw it before the due date or 15th October or 15th April, right? So what will happen? Whatever is the excess amount, so along with the my $1,500, I withdrawed excess $500. So what will happen? If that account is a Roth IRA, then it will not be taxable. As I mentioned, contributions were not deductible and distributions are not taxable. But if it's a traditional IRA, okay, then also it is not taxable. Only the excess amount, like let's say 1,500 I deposited, right, and 1,500 was only the limit for me to deposit. So whole 1,500 I am taking as a excess contribution. Let's say 6,000 was my limit. I am less than 50 years. So 6,000 is my limit. What I did, I made a contribution of 7,500. So extra 1,500 I can withdraw as it is. So this whole 1,500 will not be taxable, even if it's a Roth or traditional. But I am, instead of withdrawing 1,500, I am withdrawing 2,000. So what will happen? This 2,000 is having an extra distribution of $500. So this extra $500, if it's a Roth, then only it is not taxable. If it's a traditional IRA, then I'll have to include it in my income and it will be chargeable to a 10% on early withdrawal penalty. We have already seen this in our regular class that if you're withdrawing it, you will have to pay a early withdrawal penalty. So this extra amount will be called as a early withdrawal penalty. Okay. Next is, what is deductible contribution? So see, as I mentioned that you have to, in your 1040 formula, you will see that there is adjustment to income. In that adjustment, you can take a deduction of whatever contribution you have made. On the first few lines, there is a gross income. In that income, you will mention the distributions. Okay, so if you are going to contribute certain amount in the IRA account, you will have to take out deductions. For that also there is a limit. Now see, here you will get confused. Phase out limit for contribution is not there for traditional IRA, but for Roth IRA, contribution limit is based on the phase out limits. Okay, Roth IRA, when you contribute, it is not deductible, but they have given you the limit that only up to this amount you can contribute in the Roth IRA. Okay, the total is what, 6,000 or maybe 7,000 depending on the age. But for Roth IRA, if your modified AGI is between 2,04,000 to 2,14,000, your 6,000 or maybe 7,000 will get phased out. Okay, same way for MFS and for single and HOH, they have given the limit. For MFS, it is 0 to 10,000. For single and HOH, it is 129,000 to 144,000. Got it, guys? Contribution limit is there in case of Roth IRA. Phase out limits applied in case of Roth IRA, not in traditional IRA. Please remember this. While solving the MCQs, I know I have received so many doubts on this topic, but you make the mistake. In case of contribution, we have limit only in Roth IRA. Phase out limit I'm talking about. Now, how much is deductible? As I mentioned, traditional IRA is deductible, right? Roth is non-deductible. So for Roth, deduction limit you don't have to check at all. So for Roth, there is no deduction in the adjustment to income, but for traditional IRA, you can take a deduction based on your MAGI. Okay, modified AGI, whatever is your amount, you will have to phase out, and that will also be again divided into two parts. First, if the taxpayer is covered by a retirement plan, means what? Let's say taxpayer is working somewhere and he is covered by the retirement plan by the employer. So the employer maybe has taken a 401k plan for his employee or any XYZ plan, retirement plan for the employee, then this taxpayer will be called as covered by the retirement plan. If these things happen, then the contribution limit is, let's say 6,000, 7,000, but out of that 6,000, 7,000, they can take a deduction based on their phase out limits. Okay, so what is the phase out if the taxpayer is covered by the retirement plan? 68 to 78,000. For MFG, it is 1,09,000 to 129,000, and for MFS, it is 0 to 10,000. Okay, so you guys have seen this limits. These limits are for Roth. Don't get confused. Roth contribution limits are different, and traditional IRA deductible contribution limits are different. Okay, now if the taxpayer is not covered by retirement plan, he is not covered by the retirement plan, and if he's single, HOH or qualifying surviving spouse, then there is no limit. There is no limit in taking the deduction. You can take the whole 6,000, 7,000 as a deduction. Same way if you're an MFJ or MFS, there is no limit if you are not covered by the retirement plan. See, when you're covered now, you can't take the double benefit. That's why they have given you the phase out limit. If you are already not covered by the retirement plan, there is no limit in taking the deductible contribution if you are a single, if you are a MFJ, MFS, any status. But let's say you are a taxpayer, you are not covered, but your spouse is covered by the retirement plan, right? Then what will happen for you? The limit will be 2,04,000 to 2,14,000, and the spouse who is covered by the retirement plan, for her we will see this limit. Taxpayer, or for the spouse who is covered by the retirement plan, this limit will apply. And for you being a taxpayer, the spouse is covered by the retirement plan, this limit will be applied, that is 2,04,000 to 2,14,000. Okay, and for MFS, the limit is same in all the scenarios, 0 to 10,000, 0 to 10,000. Here also it will be 0 to 10,000. Got it, guys? Please, I know I'm going a little bit fast, but as I mentioned in the yesterday's session, those who are joining for the first time today, I'll just let you know that this is a rapid revision. My speed will be this only. If you want to have a very detailed conceptual clarity, you can attend our regular classes. Okay, but right now, since it's a revision lecture, we have already completed the course. I'll go in the speed only. Okay. So retirement account, we are clear. There are two retirement accounts. One is traditional IRA, second is Roth IRA. The maximum contribution which you can make is 6,000 and 7,000. For traditional IRA, there is no phase out limit. Maximum you can make the whole 6 and 7,000. And in case of Roth IRA, there is a contribution limit, phase out limit, I can say, based on your modified AGI. Now, in case of traditional and the Roth, if you're filing as a single filer, then it will be 6,000. If you file a MFJ, the 6,000 will get double to 12,000. Same way, if your any particular spouse or the taxpayer is more than the age of 50 or exactly 50 years of age, they can get a catch-up contribution limit of 1,000 extra. Okay, now this is the limit which is given by the IRS, so that if you contribute more than this, you have the last chance before filing your tax return to withdraw the amount. If you do not withdraw the amount, you will have to pay a excise tax of 6%. Okay, and if you withdraw extra amount, it will be charged to a early withdrawal penalty. We'll see what is early withdrawal penalty and what are the exceptions, that if you withdraw it for this particular things, it will not be taxable. Okay, deductible contribution we have seen. In case of Roth, it is not at all deductible, so we don't have to read that. But for traditional IRA, whatever contribution you are making, that is deductible based on the phase out limits. Okay, you'll have to remember that depends on whether the taxpayer is covered by the retirement plan or not. And the second is whether the taxpayer or his or her spouse is covered by the retirement plan or not. Okay, got it, guys? Next is qualified charitable distribution. We'll come to this last. First, let's understand what are the distributions. When you take a distributions now, whether it is taxable or not. As I mentioned, Roth IRA will not be taxable. Okay, for traditional IRA, it will be taxable. Got it, guys? But this distribution, if you're making after the age of 72, it is mandatory for you to take a RMD, that is required minimum distribution. What IRS says that when you were earning, you accumulated all your earnings through retirement account. Now you are of age 72, now you are getting retired. It is mandatory for you to take a RMD, required minimum distribution. If you do not take required minimum distribution, they will charge you a excise tax. 6% was there in case of, extra contribution, and here directly 50% excise tax will be chargeable if you do not take the required minimum distribution. In your exams, they will not ask you the calculation that how much you should withdraw or anything. You just have to remember, as you reach the age of 72, right, you'll have to take a required minimum distribution if you're not taking any distribution from your retirement account. Okay, now let's see from what age you can take a distribution. The age is 59.5. So 59.5 is the age limit which is fixed by the IRS, that before that you can take the distribution, but it will be chargeable to the penalty of 10%. Additional tax penalty will be leviable, that is called as early withdrawal penalty. Okay, but if you take a distribution after this age, that is 59.5, and this distribution is regarding traditional or Roth or a self-employed plan or a simple matching plan, right? Then in that case you will have to pay a penalty if you take it before 59.5. If you withdraw it after this age, then the penalty will not be leviable, but this type of plan, if it's a traditional plan, whatever distributions you are taking will be taxable. It will be taxable on your 1040 page 1. If you have seen somewhere, line 3 is there for the retirement benefit, any distributions which you are going to take. Got it? For Roth IRA, simply the contributions were non-deductible, distributions are not taxable. Okay, now this penalty of 10,000 will increase to 25%. Remember this, there will be one question based on this 25% penalty. This 10% will increase to 25% penalty. What if it's a simple IRA and it is withdrawn within 2 years from the date of participation? Let's say I've participated in the simple IRA. Simple means it's a matching plan. Employer and employee enter into a match plan, like employee contribute 50%, employer contribute 50%, right? That is a simple matching plan. So in that case, I can say it's incentive matching plan. Okay, incentive matching plan. In that case, what will happen is you will have to be there. You'll in that particular account, you don't have to withdraw a single dollar from that amount, from that account, for at least 2 years. Actually, the benefit of this plan is what? It's for a future benefits, and if you're withdrawing it within 2 years, now you will be liable to a heavy penalty of 25%. It will be taxable also, plus the heavy penalty of 25% you'll have to pay on all the withdrawals. Got it, guys? Now in case of early withdrawal penalty, what you are going to do is, when you are going to withdraw, this 10% penalty will be leviable. But let's say you are withdrawing for any of these 3 purpose. Okay, if you are withdrawing for a qualified IRA, if you're withdrawing from this account, qualified IRA, or if you're withdrawing from only qualified plan, or if you're withdrawing from IRA account only, or if you're withdrawing from a Roth IRA, then there are certain exceptions that if you use it for a particular purpose, then it will not be leviable for a 10% penalty. And mostly the whole questions from this chapter is based on the exceptions only. They will give you a lot of scenarios. You have to understand whether it is falling in any of these three, 4 situations or not. Okay, so if you're withdrawing from a qualified plan or a IRA plan, qualified plan or IRA means what? Your traditional IRA, your SEP plan, your simple plan, means I can say other than the Roth, all are your qualified or IRA plan other than Roth. Okay, so distributions made to a beneficiary estate after death. If a person is dying and after his death, the distributions are made to the beneficiaries of that particular person. Let's say family of that person is getting the distribution from the IRA due to death. So that distribution is not chargeable to 10% penalty. Okay, right now what we are learning is exception to this 10% penalty. See, there is a lot of things. When we reach the last point, you will forget that what we were learning. Actually, we are doing exception to 10% penalty. Okay, second is taxpayer is totally and permanently disabled. Once a person becomes totally and permanently disabled, the age criteria will not be seen that 59.5 years is less than 59.5 or more than that. It will not be taken into consideration. You are going to take the distribution without any additional penalty. Distribution made as a part of taxpayer's life expectancy by way of periodic payment. This is the continuation with the second point. Okay, let's say you are withdrawing the amount, and you are also separated from your employer. Okay, you're leaving the job, you withdraw the amount, but you withdraw before 59.5 years, means you're taking a early retirement, I can say. So distribution made as a part of taxpayer's life expectancy means during the upcoming years you are going to take a predefined distributions, like let's say for 10% or 20%. you are going to take a distribution, you're going to make a distribution in upcoming month. Okay, so taxpayer has taken an early distribution before 59.5, but that is due to his becoming separated from the employed, he's getting early retirement. Okay, this is the third point I can say. Fourth point is distribution is applied for medical expense. Okay, so if you're using the distribution for medical purpose, and this distribution should be less than our medical expense deduction, which we will see in our schedule A. Schedule A, what is the limit of medical expense? Whatever is the medical expense you are incurring, you'll have to reduce 7.5% of AGI. That much amount you get the deduction on your schedule A. So what this point is saying is, whatever deduction you take on schedule A, right, less than that you should take the distribution, not more than that. Got it, guys? Understood this one? This is important. Next is due to an IRS levy of the plan. Let's say IRS has levied your plan, and now they want to withdraw the amount for repayment of any of the past dues of the taxes. So due to the IRS levy, qualified military reservist distribution, being a military member, if you're taking a distribution based on that, then it is allowed. No penalty for 10% will be leviable. I'm again and again repeating the purpose what we are learning. 10% penalty will be not leviable in all these cases. Okay, relating to certain federal emergency, if there is a federal emergency which is declared in your city, in your state, then you can withdraw up to 1 lakh without leviable of any penalty. Distribution in case of qualified birth or adoption. Let's say a taxpayer and the spouse are adopting a particular child, and in that case, if they withdraw up to $5,000 from their retirement account, that is allowed. No penalty for 10% will be leviable. But this $5,000 will be allowed within 1 year from the date of birth. Okay, so within 1 year of the date of birth or adoption, and the age should be less than 18 years. Whoever you are adopting, the person should be less than 18 years. Okay, each parent will get $5,000 for each child. Let's say they have a birth for one child, they are adopting one child. So for two child, they can take $5,000, and each parent can take a $5,000. Got it, guys? Next is qualified plan only. For a qualified plan only means only for traditional IRA. Only for traditional IRA, if you take a distribution after the age of 55, plus the taxpayer is separated from the service. Okay, for traditional IRA, and also there are certain qualified plan like 401k plan. Okay, this we'll see later on. Regarding what are the qualified plan, what are the IRA plans. There is a difference between these two plans. Okay, so that's why I'm saying this. Remembering this criteria is important. Okay, so distribution, if it is made after 55 years of age, plus taxpayer is separated from the service. See, actually the age is what, 59, but if you withdraw it before 59 but after 55, plus you are separated from the service, and distributions, in that case 10% penalty will not be applied. Okay, next is distributions are made from a qualified government plan. Okay, there are some qualified government plan, means let's say there is a government school, and the teachers who are working in the government school, for them the government has came up with a retirement plan, that is 501c, like that kind of plans are there. So if you are taking a distribution from a qualified government plan, right, and if a taxpayer were a qualified public safety employee, means you are a government employee plus you have taken a distribution from a government plan, and the taxpayer has reached the age of 50 years. Here, you know, in this IRA topic, there are a lot of age limits which you have to remember. Qualified plan, government plan, here the age limit is 50. The normal qualified plan, the age is 55. Distribution limit, the age is 59.5. RMD distribution is 72 years. Got it, guys? Just remember this all things. Next is distribution to alternate payee under QDRO. So this is a plan which has been developed where you are getting a distribution to alternate payee, not the person who is owning the account, but to some other person you are going to give a distribution. Reservist plan kind of thing. It's similar to the military reservist distribution. Same way it is there. Okay. Distribution of dividend from employee stock ownership plan. Okay, in the name of dividend, if you are going to get a distribution from the IRA, so this is one exception, but it will be allowed only in case of qualified plan. Qualified plan will be all related to employer employee related plan. Traditional IRA will be included. Okay, corrective distribution of excess contribution, this we have already seen, means my limit was 6,000 but I contributed 7,500. So corrective distribution means I am withdrawing the extra 1,500, even though I am withdrawing it before 59.5, but it is just to correct my distributions. This 1,500 will not be leviable to any 10% penalty. Okay, now only for IRA, what will happen is when you are buying a home for the first time. So first time home buyer distribution, you can take up to $10,000 for each spouse. Okay, distribution for a qualified higher education. So if you are taking the distribution for education purpose for buying your first home, distribution for health insurance premium paid while unemployed. Okay, health insurance premium paid while unemployed. When you are not employed and if you want to pay your insurance premium, you can use your IRA account. But if you are employed and you are using your IRA account to pay the health premium, that is not allowed. Okay, next is returned IRA contribution if withdrawn by extended due date. That is the same thing, that is corrective distributions if you are making in your account. Okay, for IRA account. For Roth IRA, what is the thing it is mentioned is, Roth IRA, the limit is distribution should be made after 5 years, from the date of first contribution. The day when you contributed in the Roth IRA, till 5 years, you should not withdraw. If you withdraw, see, you know it is not taxable, but early withdrawal penalty will be leviable if you withdraw before 5 years. Okay, plus in that case, one exception is there. If you withdraw before 5 years, right, and if it is made after 59.5, so that there is no meaning in reading this, because you know that after 59.5 there is no penalty leviable, right? So when you distribute after 5 years plus it is made after 59.5 years, or if it is for any of this purpose, it is for buying a new home, for qualified education expense, for health insurance, right, and for a returned IRA, means extra contribution if you have made. In Roth IRA, we have seen there is a phase out limit in contribution. If you have made the excess of that, you can withdraw it before the due date of return. Got it, guys? This all criteria you will have to remember. I don't have any way to teach you to mug up the things, but you will have to remember. Simply you can remember like this. If it is used for a qualified purpose, for IRA and for Roth IRA, what are the 4 qualified purpose, guys? It is for buying a home up to 10,000 is allowed, education expense, health insurance if unemployed, and returned IRA. These 4 situations are there in the last 2 charts. Okay, for qualified IRA, for a qualified plan only, we have certain age limits. Distributions are made after 55 years of age plus separated from the employer. Okay, from the service. If it is a government employee, you can take a distributions after 50 years of age, plus that person has to be a qualified public safety employee, okay, and should have reached at the age of 50, right? Then we have a dividend distribution from an employee stock ownership plan and a corrective distribution. So here you can remember the 2 age limits, and the first point is where the person is taking distribution due to death, due to a permanent and total disability, right? And based on your life expectancy, if you are retired from the services, if you are separated from the employer. Third thing is, if you take a medical distribution, if you take a distribution, use it for the medical purpose. Okay, but one thing you have to check here is whether it is more than what you're showing on the schedule A, or it is less than that. If it is less, then only it is allowed. If it is more than excess, which is going, will be allowed, will be taxable as a 10% penalty. Got it, guys? This much clear, everyone? So this were the distributions, prohibitions, I can say, or I can say exceptions for the penalty. Distribution prohibition is what? Up to 59.5, you should not withdraw it. If you withdraw it, 10% penalty will be leviable. Okay. Please confirm in the chat, are you understanding these points? We have already done this in the regular batch. Again, I'll give a disclaimer. Those who are attending my session for the very first time, they won't be able to get these topics because this we have already done in the class very well. Now it's just a revision of it. Okay, so I hope those my existing students, please confirm those that you have, you are getting this point, you are understanding it and revising it properly. Okay. All right. So distribution due to death is what? Something which will be allowed. Distribution due to death will be allowed in case of surviving spouse. Okay. Treat as their own IRA. Now here you have one more concept, that is IRA rollover. Rollover. Okay. So IRA is an account which can be rolled over to in the name of the spouse. Let's say the taxpayer is dying. Okay, now the spouse can convert the IRA of a taxpayer in her own name and she can continue in her own name. That is what we called it as a rollover. Second thing is, let's say one IRA account you are maintaining, now you are withdrawing the whole amount and transferring it to another IRA account. Okay, and if this thing happens within 60 days, means you withdraw it and you deposit it to the other IRA within 60 days, then also it is allowed without any restrictions. Okay, but in case of death, only and only your surviving spouse can roll over the IRA account. No other person, not even their own child, not any dependent, no one can roll over the amount in their account. Okay, so only the surviving spouse can treat as their own IRA by rolling the account in their own name. Other beneficiaries what must withdraw the entire balance. Let's say the child is going to have the whole IRA amount, they will have to withdraw the whole balance within 10 years. See, there is a lot of huge amount which will be stored in the IRA account of the parents. Now, it's not necessary to withdraw whole amount at the same time. They can withdraw it in within 10 years, anytime, either in the lump sum or they can have a distribution in particular time period, time interval, but that has to be less than 10 years. Okay, what is the method of distribution? You can take a lump sum, you can take a life expectancy, or a 5-year withdrawal deferral. 5-year deferral means you deposit the whole amount into a 5-year. I'll just take one example. In India, we have fixed deposit, right? Whenever there is a death of a person, you receive a life insurance whole amount. The whole amount you take it and deposit into the FD. 5-year FD, 10-year FD, 7-year FD. That is what 5-year deferral means. You are not taking the whole amount as a distribution right now, but you are investing somewhere else. Okay, but that whole distribution has to be taken within 10 years. Okay, now exception to 10 years, this 10 years will not be seen in case of surviving spouse. If the person who is taking the distribution is a child of the account owner who has not reached the age of majority, means less than 18 years, okay, it's not necessary for him to distribute and take the withdrawal within 10 years. Right now, let's say he's just of 6 years of age, he is going to get the benefit of all the IRA account of his parent, right? So it's not his duty to withdraw within 10 years, right? So this is an exception. Next is disabled or chronologically ill person who is going to have the benefit of the IRA account. Okay, disabled person is there, child of the less than the majority age, surviving spouse, person not more than 10 years younger than the IRA account owner. Let's say IRA account owner is of 50 years. Okay, and the person is not younger than 10 years than this particular age, means the person is less than 40 years. Okay, less than 40 years. Got it, guys? So these are the 4-5 exceptions for withdrawing before the 10 years withdrawal limit will not apply in this case. So I hope the IRA topic is clear. We have done what contribution we can make, what distribution we can make. In case of distribution, what are the restrictions which will be applied, and if there are exceptions, these are the exceptions, then the 10% penalty will not be applicable in that case. Okay, and distribution due to death, in that case surviving spouse will roll over the whole account, and if it's a other person, other beneficiary other than the surviving spouses, then they can't call that IRA account in their own name. They will have to compulsorily withdraw the amount. Okay, Next is, let's do the prohibited okay, before moving to that, let's complete the qualified distribution by way of charitable distribution. Here the age limit is different. If you want to, distribute the amount into charity directly from your IRA account, this is allowed only in case of traditional and Roth IRA. The employee related plans will not be allowed to take any charitable distribution. Means 401k plan, simple plan, SCP plan, that will not be allowed to take a charitable distribution. But if it's a traditional and Roth IRA and the taxpayer is having the age of 70.5 years of age, at least minimum the person should be of this age, and if this happens, then the distribution which you are going to take will be non-taxable, means made directly by the trustee of the IRA, means who is handling the whole account, that is called as trustee. We'll see that certain restrictions are there with the trustees also. So if the trustee is handling the whole account and made directly by the trustee of the IRA to organization who is eligible to take a tax deductible contribution, means we have seen in the Schedule A topic, right? In Schedule A, there are charitable contribution in which there are qualified and non-qualified organizations, right? For qualified organization, if you are making this deduction distribution from your IRA account, then it is non-taxable distribution. Okay, but how much maximum you can donate in a charity? Maximum you can donate is $1 lakh, $100,000. And if you're a MFJ, you can donate up to $200,000, right? And it will be reduced by deductible contribution for all taxable year after taxpayer attains the age of 70.5. Got it, guys? What I'm trying to explain is, if you want to make directly a charitable distribution, the maximum limit is 100,000 and 200,000. The age is 70.5. Again, the age limit is there over here. You have to remember that. For charitable distribution from your IRA account, it will be not taxable if you make it from a traditional or Roth IRA, and it has to be up to 100,000 and 200,000. Clear, guys? Now let's see some prohibited transactions between the plan and the taxpayer, the beneficiary, and a disqualified person. Okay, so between the plan means any person who is acting as a fiduciary of that plan will not deal with any plan asset. Plan asset means what? All your investments which you are making in the IRA account, that is your plan asset, including any earnings on that. Okay, the person who is handling your account, right, who has been making all the contributions, distributions, like providing you the whole account, who is acting as a fiduciary, okay, who will not be able to deal with your plan asset, means all your contributions including your earnings, they will not deal with this in their own interest. Okay, if they deal with that for their own interest, that is called as prohibited transactions. What will happen in case of prohibited transactions? There are limits and some penalties, interest, we'll see later on. Okay, if the taxpayer or fiduciary, T or F means taxpayer or fiduciary, or uses the plan asset or income for the benefit of disqualified person, either they use for own interest, either they use for disqualified person. We'll see what do you mean by disqualified person. Here the definition is mentioned. What do you mean by disqualified person? Fiduciary himself or any of his related person, okay, who is handling the whole account, the fiduciary himself or all his relative will be called as disqualified person. Second, person providing service to the plan plus any of his related person. Okay, person providing service, fiduciary plus any of his relative, any of the relative is covered for all the type of disqualified person. See, employer, if any of his employees covered by the plan. Let's say employer Mr. X is there, he is having a lot of employees, so this Mr. X will be called as a disqualified person. For the employees, if he has taken a 401k plan or any simple plan or any of the retirement plan on behalf of the employee, then this employer will be called as a disqualified person. Okay, employees organization, if any of the members are covered. So Mr. X is having X and company, so this whole organization will also be called as a disqualified person when we look at the employees, right? Employees IRA account. Got it, guys? Employer, employee organization, the person who is providing service to the plan, and the fiduciary. So these were the four things which you can remember. The fifth one is employee plus employer organization direct or indirectly own interest of 50% in any of the above points. Let's say employee, employer, the other employee who is owning 50% or more interest in this organization will be called as a disqualified person for other employees plan. Okay, this is what it means. Employee plus employer organization, directly or indirectly the owner of the 50% interest of any of the above, right? If they are, let's say this person is in partnership with the relative person of Mr. X, 50-50% partnership is there. So can I say he is related in any way more than 50% in above all the 4 points, right? Then that person will be called as a disqualified person. Member family of the above having direct or indirect more than 50% interest ownership in either the company or with anyone else. Okay, member or a family of above who is having direct relationship of more than 50% interest, direct interest of more than 50% with each other, means let's say they entered a partnership firm, they are having interest in the some other organization, and that other organization is having interest in the X and company, so that will not be allowed. That is called as a disqualified person. Okay, officer director who is more than 10% shareholder or a highly compensated employee, and in case of partners more than 10%. You have to remember the last 2 points are important, guys. You can just mark it down. In exam they will give you this indirect way. You'll have to understand that this is a disqualified person. Any transaction entered with this disqualified person is a disqualified transaction. So what it is, officer director of a company, more than 10% shareholder, here 2% shareholder is not there, more than 10% shareholder or a highly compensated employee. What do you mean by highly compensated employee? Who is earning more than $135,000 during the whole year, right? That is called as highly compensated employee. Partner, if it is having more than 10% of a interest, partnership interest. Okay. Now, if you enter into prohibited transaction, let's see what is prohibited transaction. We know what is disqualified person. Any transactions which entered by a disqualified person with a retirement plan is a prohibited transaction. Okay, what are that? We were learning about that only. Act of fiduciary, transfer of use of plan asset or income of a disqualified person, receipt of consideration by a fiduciary in his own account. Let's say the distribution have been taken out by the fiduciary and it has been deposited in his own account. That is a prohibited transaction, that is not allowed. Receiving unreasonable compensation for managing the plan. Okay, he's the manager of my plan, he's handling all the thing and I am giving him a compensation of 20,000, but the market value of this compensation is 10,000. So can I say the extra 10,000 which I am paying is a prohibited transaction? Any act between the plan, between the disqualified person. Okay, what are the act? It can be selling and exchange or leasing of the property. Means, see, it sometime it happens that I am keeping the whole retirement account and the mortgage and taking out the loan, or I am selling the whole account or exchanging or leasing the property based on my retirement account. Okay, lending the money or extending the credit from my account, and furnishing the goods or service or facilities. Let's say my plan manager is providing me some other goods and service and facility. Being a plan manager, he cannot sell me goods, he cannot deal with me in any manner. That is a act between the plan and a disqualified person, right? That thing which is entered between the two people, if these transactions are entered, these transactions are called as disqualified transactions, prohibited transaction. Now what is the consequences of this thing? If you are entering into a disqualified transactions, then prohibited transactions will be leviable to a 15% of penalty. Okay, here one more penalty is there, 15% of penalty, and if it is not paid now, then whole 100% which is involved into this transaction will be leviable as the tax. Okay, 15% tax will be leviable on this prohibited transaction. If you don't pay, the whole 100% involved will be leviable to a tax. Okay, pension or annuity from a non-qualified deferred compensation plan or a non-government section 457 plan are reported on schedule 1 line 8T. Right now if you have seen the 2022 1040 form has been changed, sorry, 22 1040 form has been changed since previous year. In that you can see on line 8T of schedule 1 I'm talking about, okay, that at that it will be reported the pension annuity from a non-qualified deferral compensation plan or a non-government plan. 457 plan, non-government plan, if they are taking distribution from these two plans, they will be reported over there. No need to remember this. Actually, this was just one changes which was done in 22. That's why we added the line over here. So I hope now IRA topic is done. Everyone understood very well what is the contribution limit, distribution limit, prohibited transactions on which the 10% penalty will not be leviable. Everything is clear, okay? Now let's do one more thing. Along with this, when you make a contribution now, you can take a credit. This credit is called as saver's credit. So let's understand that, because right now only we have done the contribution. So let's do that credit once. Just give me a 1 minute. Taxes, and yeah, here it is. See, saver's credit will be non-refundable when you are contributing into a qualified retirement plan. Qualified retirement plan, I can say traditional retirement plan, okay? So here you can file a form 8880 to take the credit, and the credit will depend on again your modified AGI. Your AGI for MFJ filer, for head of household filer, and for any other taxpayer, if it is falling between this limits, okay, up to 41,000, up to 44,000, 68 and more than 68, then how much credit you will get? You will get a percentage of your contribution. Do you remember 6,000, 7,000 was your contribution, and that contribution was again limited based on the phase out in case of Roth IRA. But for traditional IRA, there was no limit, there was no phase out. So 6,000, let's say 6,000 is your contribution, you can take a 50% of your contribution amount as a credit. Can you understand how much benefit IRS is providing when you are contributing in a retirement account? You first can take a contribution as a deduction to your AGI, adjustment to the gross income. Later on, when you reach to the tax liability, you can take a credit, which is straight away 50% of your contribution if your AGI is up to 41,000. In class also I have mentioned this thing, higher your income, lower are the benefits, right? So higher, as soon as your AGI increases, the contribution percentage will get reduced to take the credit. Okay, so you can, if you can remember, please remember this. I know there are not so much time left in your exam, but still at least remember the percentage: 50, 20, 10 and 0 percentage based on your AGI, that is 41, 44, 68 and 68. Okay, 41, 44, 68,000 for MFJ. For HOH it is 3750, 33,000 and 51,000, and for the other taxpayer is 2,500, 22,000 and 34,000. Please remember this limit if possible. I'm not forcing you, but at least remember the percentage: 50, 20, 10 and 0%. Okay. Eligibility. Who will be eligible to take this credit? The person who are eligible should have made the contribution in the traditional Roth deferral to 401k or any after tax employee contribution. We are talking only about employee contribution. Based on your employer's contribution, you can't take the credit. Like let's say 50% is been deposited by the employer, 50% is been deposited by the employee, then only the employee's part will be considered for the saver's credit calculation. Okay, or if you are contributing to any able account, okay, it's also a kind of retirement contribution account which is being used. So if you are contributing in any this type of account, then only you can take this credit, saver's credit. Right now there are some exceptions, that if you are falling under any of this. Yes, Karan, daily revision lectures are uploaded on the YouTube. If you have not followed the channel, I know I'm going a little bit fast, but if I go in a very slow manner, there is no point in taking the revision lectures. Your EA guide, you can see the logo on the top in the screen over here. It's the name of the YouTube channel. Daily basis at evening time the lectures are getting uploaded. So please, if you are missing any points, or if you're not able to understand, go over there, watch out the recordings. Okay, pause it, make your own notes, or you can watch it in a fast forward manner if you are already watched twice or thrice that recordings. Okay, next is C. In case of taxpayer who are having AGI of more than the limit. Okay, so this 68,000, actually here the limits are not changed. Here you can just change it. It's instead of 33, make it 34,000. Instead of 49, make it 51,000, and 66, make it 68,000. Okay, so what you are going to do is you have to see that if your AGI is more than this all amounts, right, then you are not going to get any credit. Okay, if you are going to claim as a dependent on owner's return, means let's say I am been claimed in dependent in someone else's return, and I am contributing to IRA account, my owner is not going to get that credit. Okay, he will have to make his own contribution, he will have to take his own credit in his own return. Based on my contribution, he cannot take, just because of the reason that I am being carried as a dependent on his return. Okay, if the age is less than 18, let's say a particular person's age is less than 18, he is earning certain income, he is making the contribution, but still the savers credit will not be allowed. Okay, and taxpayer is a full-time student. Even if the taxpayer is a full-time student, then also the owner's credit will not be allowed. Sorry, savers credit. Got it, guys? So everyone, please, when you read the IRA topic now, please make sure to read this credit along with the IRA topic, that is savers credit, which is a non-refundable credit. Okay, so let's see what was our next thing which we are pending from the today's topic. IRA done, savers credit is done, retirement credit, savers credit, actually it's the same thing, and SSB is remaining, and 529 plan. Yeah, so let's move to the SSB, social security benefit. It's very easy when we do it from our chart format. I hope it will help you guys to remember it easily. Just a minute, guys. Let me open that SSB topic. Yeah, here it is. See, in case of social security benefit, what happens now? When you're earning, what IRS expect is you have to save money from your earnings. So when you save the money from your earnings, that is covered in your retirement account. Okay. Now, if those who are working, you might be knowing this thing. In case of social security taxes, certain percentage has been deducted when you receive a wages. When you receive a wages, you get you have to pay a social security tax and Medicare tax to the employer. Okay, so when you pay this thing, what is the benefit of that? When you retire, you will start receiving a social security benefit based on whatever contributions you have made. Okay, so social security benefit will be calculated when you receive it. See, when you anything which you receive will be your income, and if you have an income, it will be taxable. But social security benefit, when you receive, it will be taxable up to certain percentage. Either it will be taxable only 50%, or it will be taxable up to 85%. I'm talking about the taxable amount, not exempt amount. 50% is taxable or 85% is taxable. How this will be calculated? This will depend on a simple timeline. First, you have to calculate a provisional income. What do you mean by provisional income? Take all the AGI, add tax exempt income, add foreign income, add 50% of your social security benefit which you are receiving. When you do the total of these three things, you will get a provisional income. Okay, now this provisional income is your base to calculate what amount of social security benefit will be included, either 50% or 85%. Got it? First thing you have to take it is a base amount. What is the base amount? If you are a MFJ filer, you have to remember this limit also. Make sure you remember this limit. Okay, if you are an MFG filer, the base amount is 32,000. If you are any other filer, it will be 25,000. For MFS, 0 is the base amount, means whatever social security benefit you are going to receive, being a MFS now, you will have to pay whole amount as a, like, take whole social security benefit, take 85%. Maximum taxability is 85%, guys. So take whole 85% and make it taxable on your tax return. Got it, guys? So take the base amount, that is 32,000 or 25,000. Okay, now what you are going to do is you are going to also calculate adjusted base amount. What do you mean by adjusted base amount? Your base amount plus 12,000 means what was your base amount? 32,000 plus 12,000, that comes to 44,000. What is your base amount in case of the MFS? That other filers, MFS is 0. Okay, for other filers is 25 plus add just 9,000, it will be 34,000. Okay, now check your provisional income. If it is falling below base amount, what was the base amount? 32 and 25, 0% will be taxable. Okay, now if your provisional income is falling above adjusted base amount, see, up to this now 0% will be taxable. Above this, 85% of your social security benefit will be taxable. But the main calculation will come when it falls between these two amounts, between these two line items. If you're between the 32 and between 44, or 25 and 34, if your provisional income falls, you will have to make a calculation that only 50% will be taxable. Okay, so for this calculation, I think I have already uploaded one of the that limits PDF on the LinkedIn. I'll share it in the group. Those who are already added in the group, they can access from the WhatsApp group only. So over there, the whole calculation steps are mentioned. Okay, so there are slab calculations which you have to do. Let's say my provisional income is just 40,000. Okay, so can I say it is falling somewhere between these two figures, right? So up to 32,000, na 0% SSB is taxable, but as soon as it goes above 32,000, 50% is taxable. So how you are going to calculate it? For that, we have given one note. So let me just take one example. Actually, those who are having claim book, it will be there in that example. Sorry guys, just give me a 1 minute. It will be clear crystal from that one that question. Yeah, it's here. See, what you have to do is, I'll just take this example, you'll understand it. Mr. and Mrs. Slom both are over 65 years and they are filing a joint return, and they receive 20,000 as a social security benefit. Additionally, they reported 30,000 as a taxable interest, 15,000 as a tax exempt interest, 18,000 as a dividend, and a taxable pension of 16,000. So can I say, first you have to calculate the provisional income. What is the provisional income? Take the AGI. What was the AGI? It is 64,000. Add the tax exempt interest, that is 15,000, that comes to 79,000. Okay, that is a modified AGI. Now, can I say this 79,000 is falling? They are a MFJ filer. So what will be the base amount for them? It will be 32 and 44. Okay, so can I say this 69,000 is falling above this 44,000? Right, but whatever was up to 44,000 now, that was taxable to 50% only. So what you are going to do is, you are going to add back 50% of the social security benefit to this total amount. Provisional income plus 50% of social security benefit, add back that much amount. That comes your adjusted, I can say, provisional income, right? That is your 89,000. See, sorry, 50% anyways we are going to add. Now out of this 89,000, what you are going to do, you are going to divide it into slabs, right? 32,000, 25,000, 44,000, and adjusted base amount and base amount, you are going to divide it into the slabs. Okay, now reduce the base amount. What was our base amount? What was the lower limit? Was 32,000. So we'll reduce 32,000. This much is the amount, that is 57,000. Okay, now you are going to reduce the additional amount to reach at the adjusted base amount. Okay, so it was 12,000. If you remember in our chart, here was 32,000. When we add this 12,000, we are going to reach at 44,000. Right? If you remember this, so first you are going to reduce the 32,000, then you are going to reduce the 12,000. That amount which comes to is 45,000. Now, out of this 45,000, this is our excess PI. I can say this is my excess provisional income. Based on this, I'll have to calculate how much is taxable and how much is exempt. First of all, what you will do, this 12,000, now take 50% of this 12,000 over here. Okay, so 12,000, 50% comes to 6,000. So whatever is the remaining 6,000, you are going to multiply the line number 9, means your excess PI, with the 85%, because since the amount of our provisional income is more than 45, so we'll multiply it by 85%. Okay, so this amount 85% amount, or after reducing the 6,000, your 44,250, whichever is lower, you will get the social security benefit as a taxable in your tax return. Okay, so this thing we have already done in our class. Right now, don't get confused with this question solution. Whatever we have done in the class, just refer that class notes. I've already explained taking 2-3 scenarios, right? So please refer that, and I'll send one whole limits PDF we have created. What all limits will be applicable in your exam, in that the social security benefit calculation also stepwise manner I have mentioned. Please follow that for solving it in the exam. Okay, so coming back to our book, that is regarding the social security benefit, we have understood that we have to compare the provisional income from base with the base amount and adjusted base amount. Okay, it will be taxable accordingly, 0%, 50% or 85%. Got it, guys? So that's it for the retirement topic. I think we have covered. Okay, from today's topic, we are left with the 529 plan. This will cover tomorrow. And tomorrow, instead of starting with the foreign topic, we will be starting with the earned income. Earned income will include your wages, your rental, your Schedule C. So Schedule C, Schedule E and wages income, all this earned income we will be taking tomorrow, because some of the topics in the foreign transactions, in foreign income, you will have to first understand the earned and unearned income. That's why tomorrow we will be taking with the earned income topic. That will be all employee related benefits, all rental income, all Schedule C income, all those things tomorrow. Same time we will be meeting at 9 a.m. Okay, guys. So that's it for the day. Have a nice day. We'll meet tomorrow. And all the recorded sessions are there on the YouTube, so please feel free to watch at any time. It will be uploaded in evening time. The recording will get processed and then it get times to upload. Okay, so thank you, guys.